Hello and welcome to this week's edition of Echo45 Advisors Market and Economic Update. Many investors are worried about a recession due to tariffs and inflation. The S&P 500 briefly fell into correction territory recently, with tech stocks leading the downturn. Over the next few minutes, we'll discuss what consumer spending means for the possibility of a recession and how investors can position for the long run. Consumer spending represents 2/3 of the economy and is crucial for ongoing economic growth. First, it's no surprise to many that consumers are feeling negative about the economy. This is because inflation has eroded the savings and purchasing power of many households in the past few years, and tariffs could raise prices further. Consumer sentiment directly affects spending, with high confidence boosting economic growth and uncertainty leading to reduced spending that affects the broader economy. This chart shows the University of Michigan consumer surveys for sentiment, current conditions, and expectations. As you can see, all three have fallen well below the average, with consumer sentiment declining to 57.9 from 79.4 a year ago. This is approaching the mid-2022 historic low of 50 and is driven by inflation concerns and uncertainty over tariffs. What's interesting is that despite poor consumer sentiment, spending has remained relatively strong, creating mixed economic signals that require broader context to interpret. One reason for this is the strong job market. The unemployment rate is only 4.1%, and there are 7.7 million job openings across the country. This creates a strong foundation for consumer finances, even though many are worried about the future. Next, household savings are the other side of the spending coin and an important factor in financial health. Household savings here are measured as a percentage of disposable income. Household savings rates can tell us important information about the overall health and direction of the economy. When household savings rise, it often indicates one of two scenarios. Either consumers have increased confidence in their financial stability, allowing them to set aside more income, or they're preparing for anticipated economic turbulence. So far this year, we've seen fluctuating savings patterns as consumers adjust to the new presidential administration's economic policies. As this chart illustrates, the household savings rate has recovered to 4.6%, but is still below the historical average of 6.2%, suggesting consumers are spending extra income rather than rebuilding emergency funds. Credit card balances grew to $1.2 trillion in the last quarter of 2024, raising concerns about debt-fueled spending. Though balances typically increase as the population and economy grow. Finally, U.S. household net worth has reached record levels despite these concerns, creating a strong foundation for consumer spending. This is often known as the wealth effect, or the idea that consumers spend more when their perceived wealth increases. That said, we understand that not all households have fully benefited from rising markets and financial asset prices. Many are still struggling with debt and limited savings despite the overall trends. This is one reason why following a financial plan is more important than ever. So, while these consumer trends do not guarantee that the economy will continue growing at the same pace, they do suggest that the economy could be more resilient than some fear. This underscores the importance of considering the bigger picture before making portfolio changes based on short-term market movements. We hope you found these insights helpful. If you'd like to discuss any of this in more detail, please don't hesitate to reach out. We look forward to speaking with you soon.